Today we will discuss about final account, that is block 2, in which we have how do we prepare final accounts and what is a company and how do you prepare a company account, that is introduction to company accounts, types of shares, kinds of companies, their issue, debentures, underwriting, and also preparation of company final accounts. So first we will understand what is final accounts and what are the different types of accounts that are prepared in final accounts. We'll try to understand. So in final account, before going into that, let us understand that every company or every business organization wants to earn profit. So at the end of their financial year, the management or the owner of that business wants to know whether the business has earned profits or not. And these profits can be understood or these profits can be known by preparing the final accounts. And in the final accounts, it includes, so we prepare final accounts includes three things. The first one is trading account. Next one is profit and loss account. And the last one is balance sheet. So these three put together, we call it as final accounts. So any business can know whether the business is earning profits or not by preparing these three accounts. That are two accounts and one statement that put together we call them as final accounts. Under that, the first one is trading account, next one is profit and loss account, and the last one is balance sheet. So in the block 2 unit 5, we will try to understand even trading account in some other businesses it will be manufacturing account also. Means if the company or if that organization is involved in uh, if it is a manufacturing concern, they even prepare the manufacturing account. But if the company or that organization is not involved in manufacturing of any products, in that case, they prepare only trading account, profit and loss account, and balance sheet. So first we discuss what is trading account, profit and loss account. Then we move to the next unit, that is balance sheet. So here, if you look at here, trading account, a business person or business organization will carry the activities like, for example, if we take any stationery shop will include books, papers, pens, erasers, all these things. Yes. So as a shop, I am not manufacturing any book. I am not manufacturing any pen. What I am doing, I am purchasing from the supplier and in turn, I am selling it to the customer. I am supplying to the, I am purchasing from the supplier and in turn, what I am doing, I am selling it to the customer. So purchase, buying and selling of goods. We are purchasing and selling to the customer. This is called trading. Manufacturing means, for example, if myself I am producing the paper, book, then I am selling, then comes the manufacturing account. So here, whenever I say trading account, what all it includes, let us see. Trading account. Account means, as in here, account means it's a ledger account. It will be debit side and credit side. Will be debit and credit. We'll have debit and credit. Now, as you know, date, column, particulars, all this will write in. Now, what will we write in debit side and what we will write on the credit side? And we are preparing the first one, that is trading account. So what actually a stationery shop person will do? First, he will purchase books from the supplier. So that is called purchases. Whenever I am purchasing, the goods are coming to the business. Yes. So I am debiting here to purchases. It's an expenditure to me. I'm purchasing the goods. Now, whenever I purchase the goods, for what purpose I will purchase these goods? I'll purchase these goods for selling purpose. So I will do sales. It's an income to me. So I'm writing on the credit side. Credit, what goes out? Goods are going out now. So I will write on the credit side. Next, I am purchasing, selling, doing the sales. Now, whenever I am purchasing some goods from the supplier, there is a chance of some damage, some broken art material, or some books torn. It may happen. So, what I do at that time, I will, because I cannot sell that book to the customer. In that case, I will return back that goods to the supplier back. That is called purchase returns. So where I have to write on the credit side because goods are going out, I'm giving it back to the supplier. But instead of writing on the credit side, what I do, I will deduct from my purchases. I will deduct from my purchases. So these are called purchase returns. I'll deduct it from purchase return. Similarly, I sold some books which I have not seen that they were damaged or pages were torn off. I didn't see, I just sold to the customer. What customer will do? He will return back. He will tell, please, this book is not good. Take it back and give me some new book. So what is customer is doing? Customer is returning back. So first I sold. Now that goods are coming back. So it is a sales return. So instead of writing on the debit side, I'll deduct it from sales and I write sales returns. Now, okay, I am purchasing and selling. I purchased goods from the supplier. That is books I purchased. Now, how the books will reach my shop? There should be some transportation mode. Yes. So that is called carriage outwards. Sorry, carriage inwards. Means the expenses which involved for bringing the goods from the place of purchase to the place of sale. I have to bring that goods from the supplier to my shop. So that are called carriage or freight charges. I need some truck or trolley where the goods have to be bring from the supplier place to my own business place. That expense are called carriage inwards. Now, okay, it's fine. If one book, two books, it's fine. I can carry it. But my shop, I'll say mine is a very big mart where I will be selling all books. So I need thousands of books. How thousands of books will be kept in the truck? I need some labor. Yes. So for labor, I will pay wages. For labor, I will pay wages. It's also an expenditure to me. I'll write debit side wages. Like this, all the expenses which are directly related to our purchases that we write in the trading account. Expenses which are directly related to our purchases we write in the trading account. That is the reason whatever expenses we write in the trading account, we call it as direct expenses. Expenses which are directly related to our purchases. Or direct expenses. That all expenses we will write in the trading account debit side. Trading account debit side. Now, okay, I have written only two expenses. Depends upon the problem, depends upon the question, the expenses goes on changing. So this is trading. Now, I purchased around 1 lakh books. I purchased the value of otherwise 10,000 value of books. I have sold only 5,000, for example. Yes, I purchased books of 10,000 or 10,000 books, but in that year, it's not compulsory that I should sell all my books, whatever I purchased from the supplier. Depending upon the customer requirement, I'll be selling the books to the customers. So in that year, I could not able to sell all the books which I purchased from the supplier. Some books are left over with me only. So that is called closing stock. That we call it as closing stock. The stock which is left over. Why I am talking about closing stock? Because these final accounts like trading account, profit and loss account and balance sheet, these three are prepared at the end of the financial year. At the end of the financial year. So in that year, now when I'm closing all my accounts, I want to know what is the stock left over with me in my business. So whatever the stock is left over, how I will know? Purchases already purchased plus all expenses and whatever I sold, the remaining stock is called closing stock. Now this closing stock means when I'm preparing, for example, if I take trading account for the year ending, for the year ending 31st March 2024. So during that period, now this closing stock will become on 1st April 2024, it will become opening stock to me. Now for this year, it is closing stock. For the next year, because I'm not going to throw that books, what I'll do? I'll keep in the shop itself and I'll sell it to the customers. So in the next year, this closing stock will become opening stock. Similarly, for this year also, in the previous year, there might be some closing stock. Now I'm bringing it to the current year, that is 31st March. So here it will become opening stock. Here it will become opening stock. And the difference of this means here the debit side and the credit side, the difference. If the debit is more and the credit is less, the debit is more and the credit is less, we call it, because debit is more means more expenses, credit is less means less income. In that case, we call it as gross loss. Gross loss. What do we call? When debit is more. Debit is more means our expenses are more and our income is less. In that case, it will become gross loss. Suppose instead of that, if it is, if credit is more, credit means our sales are more, we got more income, and here our expenses are less. In that case, we call it as gross profit. We call it as gross profit. If credit is more and debit is means, credit means our incomes and debit means our expenses. If income is more and expenses are less, we call it as gross profit and we write gross profit carried down. This is called trading account. Now, next we have profit and loss account. Actually, trading account and profit and loss account are not prepared separately. Trading account and profit and loss account are not prepared separately. They are prepared together. So here the heading is called. So here itself trading account and profit and loss account we write. Here the heading itself we write trading account and profit and loss account. Here itself we write it. And continuation to this account only we will draw here on the credit side. That is by gross profit brought down means we will bring the gross profit to the profit and loss account. We write in the same account. We will not draw any other new account. In the same account only we will prepare trading account and profit and loss account. So this gross profit will be brought down to the profit and loss account. So by gross profit brought down. by gross profit brought down. Now, in profit and loss account, this is trading account and profit and loss account. In profit and loss account, we write all indirect expenses and indirect incomes. In trading account, we write direct. We are purchasing, selling. So whatever expenditure and whatever income, so that is called direct. And here in the profit and loss account, we write all indirect expenses and indirect incomes. So what will be our indirect expenses? For example, in trading account, we discussed wages, means labor for getting the books. It's fine. If it is a small shop, one person is enough. The owner himself will look after the business. But when you look after any big mart or big store, one person is not enough because you have to dusting should be done, cleaning should be done. So it's not possible for one person to carry on the business. So what he'll do in that case, he will take few people as employees for doing that work. So we will for employees what we have to pay. For employees we will pay salaries. We will pay salaries. Now, where these people will be sitting? They'll be sitting in some office, and it's not means in that store, and it's not compulsory or it's not mandatory that all the time I should have my own store. I may take on rent basis and run my business, so that will be through office rent. And to that office we need lighting, yes. So to lighting, or we can say electricity charges, light, fan. And if you see some marts, they will give billing everything through desktop or computer. So I need systems. For that I need paper, means stationery, I need stationery expenses for bill, and I sometimes I need pen also to verify it. So this all comes under that. And if I want to order all the material from the supplier, I have to send it through postage, some order I have to do. So postage daily charges. And normally we will every office will have telephone. So telephone charges. And if more employee, I'll give some targets to my employees that if you sell more and more products to the customer, I will give commission. So to commission to the employees. And sometimes what I'll do, I'll ask my employees, you take some books and go everywhere and sell it. So for them, they have to move from one place to another place. So I'll give them traveling charges. I'll give traveling charges to them. And whatever books I brought from my supplier, I cannot store all in the shop. So I'll store them in go down charges. It will be like this. All the expenses which are indirectly or related to our business are called indirect expenses, and that will be written. And I said that we will have computer nowadays. They are billing everything through computer. So computer I will not purchase daily. Whereas salaries I will pay every month. Rent I will pay every month. Electricity charges I will pay every month. Stationery. So these all are recurring expenses which I'll pay. But whereas computer I will purchase only once, or for after many years I will do that. Yes. So that is called asset. So on asset we will provide depreciation. On assets we provide depreciation. To depreciation on computer it may be, to depreciation furniture, because whatever books I purchase from supplier, I will put them in the shelves or racks. So that all is asset. Furniture is an asset. On assets we provide depreciation. What is depreciation again? Depreciation is nothing but decrease in the value of asset. Means for example, you purchase one refrigerator 10 years back, the same refrigerator the value now will be different. And if I want to sell that refrigerator also, its value has decreased. Why? Because we are using daily, we are opening the refrigerator, power fluctuations. So as wear and tear means we are using continuously. What is happening? It has become now outdated. Why? Because now refrigerators are with smart touch, smart screen, top storage and bottom storage, separate doors, everything. Yes. So now what happened? The rate of that refrigerator or that asset has decreased. So that is called depreciation. So we provide some expenditure as it, we are providing an expenditure, we write as depreciation. Now what, these all are expenses on debit side. Continuation of this one only I'm writing here. Now on the credit side, what will be our incomes? Our incomes will be, for example, if I have more house, I'll give for rent. So I will receive rent by rent received. Next we have, for example, I am working for some other also. So I will receive some commission by commission received. And for example, whatever profit I'm getting, I'm investing in some companies. So I will get dividends by dividends received. So whatever income they are receiving, that all we write on the credit side. And the difference of these two means again debit side, if debit is more and credit is less, we call it as net loss. We call it as net loss, by net loss. Similarly, if credit is more and debit is less, means more income and less expenses, then we call it as net profit to net profit. Now, I hope you have understood what is trading account and profit and loss account, and we try to understand how actually it will be done. Let's see the one problem where we can understand how it will be done. Are you able to understand?
Yes, yes.
Okay. If you have any doubt, you can raise that, any question. Now let's do the problem. So this is what they have explained, all the whatever we have discussed just now. So this is gross profit, that is net sales minus cost of goods sold. So this is net sales minus gross profit is equal to net sales minus cost of goods sold. So what is your cost of goods sold? Cost of goods sold is nothing but this one. Opening stock plus purchase, that is total purchases minus total purchase returns plus direct expenses minus closing stock. It means here just now we have written on debit side opening stock, and we have even written purchases less purchase returns, and we have written some expenses like wages, we have written carriage. So all these are put together, we add them. And credit side we have written sales and closing stock. Sales and closing stock. So that was in account format. And when it is kept in the formula format, this is how we write. This is how we write. That is net sales means nothing but this sales minus cost of goods sold means opening stock plus purchases minus purchase return plus direct expenses minus closing stock. From this, if we deduct the sales, we'll get the cost of goods sold. Now, see, this is the format. You can just look at here. I think it's visible. The screen is visible to you all. So this is trading account, opening stock, purchases, purchase returns, carriage or freight on purchases, wages. Outstanding wages means actually we have to pay wages to the labor, but we have not yet paid, which we have not paid. Actually, we have to pay, but we have not yet paid. That will be added to the actual expenditure. Fuel and power, customs duty, any octroi, excise duty, any loyalty charges, that all will be added to the written on the, these all are direct expenses. And on credit side, we have sales, less sales returns and closing stock. If debit is more and credit is less, it is called gross loss, which will be carried to the profit and loss account. And if it is credit is more and debit is less, it is called gross profit, which is carried to the profit and loss account. And this is called trading account. And I think few problems they have given. If you want, we can even discuss that. Yes. Do you need or shall I forward? Go ahead. Yes, Venkatesh.
Ma'am, ma'am,
Shall
what?
I, shall I discuss one problem or can I go ahead?
Uh, can go ahead. I
Oh,
mean, sir will try. See.
yeah. If you do not get, you can come in the next class and we can discuss that. Okay.
Okay.
Yeah. So I said that we will be preparing manufacturing account, trading account, profit and loss account, and balance sheet. Manufacturing account comes into picture only when the organization is involved in manufacturing of product. If we have manufacturing unit, then only we'll prepare the manufacturing account. Otherwise, we will not prepare. So if we are into manufacturing business, means if you are manufacturing the product, in that case, first we will prepare manufacturing account, then we will prepare trading account, and then comes the profit and loss account. At last, it comes balance sheet. So in manufacturing account, manufacturing means we are producing some product. In that case, what our we will purchase, we'll same we'll purchase, but what we will purchase? We will purchase raw material. We will purchase raw material, and for that also we incur carriage expenses. There also we require labor. There also we have factory expenses, and for that also we'll have manager to whom we'll pay the salary. Manager of the manufacturing unit it is. Next, we want, because there are machines that are involved in manufacturing the product. For that machine, we require power and fuel. For that machine, we require repairs of that plant and machinery. If we and that production cannot be done in open place, we will have some place or building or factory. So on that, we provide depreciation, plant and machinery depreciation, loose tools, factory rent, factory lighting, factory rates and taxes, and factory insurance. So these all are the expenses which are related to the manufacturing of a product. And here on credit side, we'll have sale of scrap, means whatever is left over, we will sell it. And remaining balance, we will transfer it to the trading account. Finished goods, we'll transfer it. Means normally, if we don't have manufacturing business or we don't have any manufacturing unit, in that case, what we will do? We will purchase from the supplier. But here in this case, we are not purchasing from outside supplier. We ourselves are producing the product. In that case, whatever the balance means, whatever products we produce, we will transfer it to the trading account. Then continues the remaining trading at profit and loss account. Again, here also we will have closing work in progress, opening work in progress. Means still they are producing. That will be there. It's a continuous cycle. Next, you can see here profit and loss account. If it is a gross loss, we'll bring it from the profit and loss account. We'll write it on debit side. If it is a gross profit, we write it on the credit side from the trading account. You can see just now we discussed salaries, rent, lighting, electricity expenses, commission, telephone charges, rates and taxes, stationery, postage, general expenses, discount. These all are expenses. These all are expenses. advertisement, package expenses, carriage outwards it is. Carriage inwards we write in trading account, but carriage outwards we write in the, because it's an indirect expenditure. Carriage outwards will come into picture when we sell the goods. So whatever the expenses that are related to the selling sales, that all comes under indirect expenses. Next, bad debts. Bad debts means whenever we sell the goods on credit basis and the customer has not paid the amount, that is a loss to us, and that loss we call it as bad debts. Next, provision for doubtful debts. Provision for doubtful debts means whenever we are anticipating that there is a chance of, again there are some customers who may not pay amount to us. So in that case, we create a provision. We create a fund on the name of that. There will be some doubtful debts where we may not receive the amount. So we assume it is an expenditure which may or which may not incur in the future. Similarly, discount on debtors. Whenever we sell goods to the customer on credit basis, those customers are called as debtors. And if we provide any discount, that is a loss to us. So we will write in the, it's an expenditure. Next, insurance, depreciation, repairs and renewals, audit fees, interest on loan taken, loss due to fire or theft or donations. So these all are indirect expenses that are related to the business. And these are the incomes: discount received, dividend received, interest earned, commission received, rent received, or any other miscellaneous receipt. Similarly, if credit is more and debit is less, we call it as net profit, and this net profit we will transfer to capital account, which is related to the owner, which belongs to the owner. Similarly, if debit is more and credit is less, then we call it as net loss. That also will transfer it to the capital account. If it is profit, we will add to the capital. If it is loss, we will deduct from the capital account. And here they given the format of the other one also. You can just look at here. It will be prepared even in the vertical form. Whenever we prepare profit and loss account in vertical form, this is the format. This format is different and this format is different. Here we write only two heads, that is revenue means income. We have only two sources of income. One is through sales, the other one is through commission or interest. Means this all whatever we written in the, here we don't have any separate account called trading and profit and loss account in this format. We don't have any other new format. We have only one format here we prepare. So here, unless here it was different, but here it is different. You can just look at here. Here we write revenue, means what are the source of income. Sales, which belongs to the trading account. Other income, this comes from the profit and loss account. We add this is total income. Next we have expenses. In expenses, cost of goods sold. Cost of goods sold means opening stock plus purchases, less purchase returns, plus direct expenses minus closing stock. That all together we write here. And employee remuneration and benefits means these all are expenses that are related to the profit and loss account. And other expenses, we all add this, deduct it from whatever the balance we get, we call it as profit before interest and tax. And if we are taken any loan and we are paying any interest to that, that also will be deducted. And that is called profit before tax. Now, if you are paying tax, that will be deducted and it's called profit available for appropriation or profit available. Profit after tax we can call. This we can call it profit after tax. Instead of profit available for appropriation, we can call it as profit after tax. Here you can write. It can be profit after tax. It can be called as profit after tax. Now, and we have some adjustments, that is interim dividend. Dividend is paid to the shareholders. If you are paying any interim dividend, that will be also deducted. And proposed means if you are planning to pay any dividend, proposed final dividend, that also will be written. And any balance if you are transferring to general reserve. And all together, again, what are the difference between these two, we will get here, that is total profit. This is how when we do in the vertical form of profit and loss account. If you want, you can just look at here. We'll discuss this problem. From the following balances extracted at the close of the financial year ended 31st March 2018, you are required to prepare profit, and they are asking only us to prepare profit and loss account. So gross profit we brought from the trading account. So we write in the profit and loss account credit side. Carriage outwards, it's an expenditure. Discount, if you can look at here, it is given in the debit, means it's an expenditure. Apprentice premium, if you can look at here in the bracket, they given CR. CR means credit side, it's an income to us. Salaries is an expenditure. Printing is also expenditure. Rent, rates and taxes, fire insurance premium, traveling expenses, bad debts, income tax paid, trade expenses. These all are expenditures. Rent received is an income. Daughter's school fee paid from office cash. It's nothing but the drawings. Life insurance premium, that is also personal expenditure, is paying. Now look at here. Salaries, rent, rates, printing and stationery, trade expenses, discount allowed, traveling expenses, carriage outwards, bad debts, and fire insurance premium. And here it is apprentice premium and rent received. If you just look at here, they have not taken three expenses. That is income tax, because income tax is paid by the individual, yes. And also here daughter's school fee paid and life insurance premium. You can just look at your income tax, life insurance premium are to be treated as drawings. So this will be deducted from the capital direct. It is not an expenditure because actually it is not involved related to the business, that is related to the owner. Owner means owner has brought what? Owner has brought capital into the business. So in that case, we will deduct income tax, life insurance premium, and also children's school fee. These three will be deducted from the capital of the owner in the balance sheet. Is it clear? So this is how we prepare the profit and loss account. I hope you all have understood this. And preparation of balance sheet we'll discuss in the next class. Any doubts till now? Is it clear?
Ma'am, clear, ma'am.
Ah,
Previously, in subsidiary books or ledger, if any errors are happen, we will create suspicious accounts like
yes.
that in this, like that in the calculating in this. If anything is missing, is there?
No, it will
Is there
not happen in trading mostly. So whenever they give some question, so you got it out that, for example, when you are doing this final accounts, if you are not getting the tallying, yes, that is your question.
yes, yes, ma'am.
Yeah, in that case, what you have to do, for example, if you look at it, this question, they given from the following trial balance, they given trial balance to us, yes. So what you have to do whenever trial balance is given, better first you total these two columns.
Okay.
Better total these two columns. If total is equal, then you should get the correct answer. If you're not getting, means you have gone somewhere wrong. But when you are totaling this trial balance, if it is not tallied, the difference you write, create suspense account, then you prepare trading and profit and loss account. And in that
Okay.
case, that you will show in the balance sheet. The suspense account balance you will show in the balance sheet. Is it clear?
Clear.
Yeah.